Hello, everyone, and welcome to another interview here at Room for Discussion. Today, we have the honor to delve into the intricacies of banking regulation, a field that most often operates in the shadows but is truly fundamental in ensuring that our financial systems are safe and sound. Our guest today, José Manuel Campa, is the chair of the European Banking Authority, an institution that puts itself at the forefront of the efforts to make the banks in our continent, Europe, crisis-proof.
With decades of experience in both the public and private sector, Mr. Campa brings a wealth of insight into how regulation adapts to new challenges in today's financial landscapes. From analyzing the most recent crises to stress tests and, of course, new players in the banking sector, prepare for a deep dive into the intermingling of banking and regulation. So without further ado, please join me in welcoming our guest, José Manuel Campa.
Thank you.
Welcome to our stage.
Welcome.
Lovely to have you.
Thank you.
Have a seat. Yes,
on the
of
right
course.
side.
Okay.
Now, good afternoon, first of all. Thank you for having your time with us today. We wanted to start off simple because you're known for your many different professional occupations, but you have always been an academic. So is there a specific reason why this part of your life is so special?
Well, first of all, thank you very much for having me. And given that introduction, I've always been an academic, as you can imagine. I'm super happy to be able to be here today, and thank you for the invitation. It's really a pleasure. It's funny that you tell me as an academic, because when I started my graduate programs, and before we were talking about how I went to grad school, thanks to this professor, who helped me get into the program. When I was about to leave, I told him, I'm going to go do this program, but I'm never going to become a professor. Then 35 years later, I consider myself an academic and a professor. I spent about 15 years being a professor, which sort of tells you, you can never tell. You should never say no, because you go out, you go around, you discover things, and life takes you to places that maybe you were not expecting. But why do I like being an academic, consider myself an academic? Because of the ability to sort of pose questions and try to have the time and the opportunity to sort of pursue those things that you think are of interest to you, whatever that is. In my case, it's the nerdy thing of international finance and banking, but other people work on other things.
Yeah. Well, moving on to your more current occupation, to make sure that everybody in the audience is on the same page, we would like to clarify a bit EBA's role.
Yeah.
So in the constellation of institutions like central banks, commercial banks, and political bodies, where does it stand?
Well, we are a regulatory agency. So basically what that means is that we're a public institution. We are part of the European Union institutions, but we are a little bit independent from the Commission or for other parts of the European Union in the sense that we have our own mandate, our own governing body, and our mandate basically is relatively simple. Mm-hmm. We write the rules for banks in Europe. For those of you that study a little bit of European law, you know that maybe regulation in Europe comes through European directives or European regulations. Directives are sort of general principle regulation that gets adopted by the countries in more or less similar ways, but somewhat different ways. And regulations, when it's a regulation that comes from Europe, and just gets applied across the board. So in the area of banking, we mainly operate in Europe through regulation. And that regulation, at the first level, the highest level, gets determined by the European Parliament and the European Council. And then we, as a regulatory agency, we develop what we call the level 2 and level 3 rules. That's the big part that we do. We write the rules of how the banks operate. And then we have two related mandates. The second one is what we call supervisory convergence, which is that we supervise that the way those rules are being applied by the national authorities across the 27 member states are similar, are analogous. So that's what we call a convergence. So it's not just that the rules have written, but the way they're being interpreted and applied, they're done the same way. And then the third one, we look at financial stability of the banking sector. I'm talking about banks, but we do a little bit more than banks, and we will get into it later.
Yeah, of course.
But so we assess, we do risk assessments, we do a stress test that you mentioned at the beginning of the banking sector. We'll do one in the first half of next year. We do it every 2 years. We assess other parts of potential risks. Like just this week, we published an assessment of how the banks and the financial sector was well prepared or not to the climate strategy of the European Union, which is called the Fit for 55 strategy, which is a strategy for 2030, and we assess whether the the financial sector will be resilient to that. So those are the three things. Write the rules, make sure that they're applied in a convergence way, and do assessment of the risks.
Yeah, amazing. Well, you said it yourself, you basically regulate banks, but you previously worked in the private sector. What switched this move back to the public sector since you worked in the Spanish government before that?
Yeah, it's really nice. I mean, as you said, I was an academic, I worked for the Spanish government, then I worked in the bank, and now back into the European Union project. It's a little bit of a long
Coaster.
right? Which comes back to my first point. You never know where life takes you.
Yeah.
So, but why do I work in this project? And why this is going to sound, I hope, consistent and coherent. But basically, I started my research on my academic career working on international finance and international integration in Europe. At the time, it was all about the creation of the euro.
Yeah.
And getting rid of exchange rates, and that's what I did early in my career, how to do that. I did that as an academic. I worked with the central banks on the research area to try to foster that. Then I went to the government during the global financial crisis, which was a moment of tension in which the solution, like many times in Europe, was to build more Europe at the time, and it was the construction of the banking union and all these areas. So for me to be able to now to lead this agency, which is the European Banking Authority, it was I don't know if it's a lifetime dream, but certainly it has been an opportunity that I could not say no, and I was very excited.
Yeah, absolutely.
On that note of your career, moving on to your work itself, you work in banking regulation, and although events like the most recent crises within the banking sector, which is of course Silicon Valley Bank and Credit Suisse, happened outside of your jurisdiction, we definitely think there's a lot of value in talking about them. So from your perspective as chair of the EBA, how would you fundamentally go over what went wrong with, say, Silicon Valley Bank?
Yeah, I mean, it's always when you're a regulator, you sort of hope that two things, that you're writing the right rules, and then you're never going to get caught by a surprise. Yeah. So you always have to be careful that this will not happen to you, because obviously the world is risky and events may happen. But talking about the experience from the US from last year, from the spirit of last year, and particularly Silicon Valley Bank, one is the importance of the rules. One big difference between the European Union and the United States is we work under what we call international standards, so as to preserve open financial markets and international financial activity. Those standards in the bank are agreed at a place called Basel in Switzerland, and was also called, therefore, the Basel rules. We in Europe, we choose to apply those Basel rules to all banks. You don't have to. The agreement is that those rules should be applied for internationally active banks because it's to preserve global banks. We choose to apply them to all banks. They're strict rules. The United States applies them only for the really large, what we call globally systemic banks. Silicon Valley Bank was not. It was perceived to be a smaller bank, so it was subject to quote-unquote weaker rules or softer rules, and that's one aspect, the importance of the rules. The second one is the importance of the supervision. Not only the rules, but also the supervision. The intensity of the supervision was not as intense. Yeah. But the third one, and most important, is the role of the managers, the people running the bank, because at the end, the banks are being run by their executives, and they have made significant mistakes in terms of the risk management. Having said that, there's one additional component that I think is important. It's a lesson learned to all of us, which is that the world moves on, technology advances, and the speed and the way in which sort of what we call bank runs, which is what happened to Silicon Valley Bank when everybody decides to withdraw their deposits quickly, that was unprecedented in the speed and unprecedented in the way it happened, because it basically happened digitally.
Yeah. Well, focusing on one of the points you mentioned, specifically the managers, the portfolio of investments that SVB had was quite undiversified and quite sensitive to interest rate risk as well. Do you think this is something that has been downplayed or kind of forgotten in the regulation sphere before we realized that there was a problem?
I don't think it's forgotten in the regulation. I think that, as I said before, like the regulation that was applied to Silicon Valley Bank was a little bit softer. So maybe that was part of the reason. They didn't have as stringent what we call liquidity requirements. Second, on the supervision part, it was not as thoroughly assessed. The supervisors in the United States had identified weaknesses, and they had asked the bank to fix it, but it took a long time for them to fix it. And then the interest rates went up, and it got them into trouble. So I think that In that sense, when we think about the lessons learned from that exercise, it's more about the managers doing the day-to-day management, making sure that they're careful about that. It's about the supervisors being more diligent in once they identify something, forcing the banks to fix it relatively quickly rather than giving them a lot of time, and less on the regulatory part.
Yeah, and well, another thing we've learned through Silicon Valley Bank is that many times, a bank's assets are not marked to market, and this causes a bit of murkiness, let's say, in a bank's actual financial conditions. Do you think that requiring, products that a bank owns to be marked to market could be some sort of way to go forward into making our system more stable?
Yeah, that's a long-term debate, because one of the big challenges that you have with the banks is that many of their assets, that there may not be a market. Or if there is a market, that the price that the market tells you is not necessarily that such a good signal because there's not enough liquidity in that market.
Only market to mark the liquid ones.
Exactly. So you need to think about those assets that are liquid. You should really try to mark them to market as much as possible. But that gets a bit more tricky because then, if I may, without getting into too much sophistication, because it also depends on how long will the bank be willing to hold those assets. I'll give you an example: bonds, government bonds. The market price of that bond may change overnight, from one day to another, depending on interest rates and other things. But if you're planning to hold it to maturity and it's safe, the value that you're going to get is certain because it's a bond. So that's why we have this part of the portfolio that we call the hold to maturity portfolio, which the rules allow you, if you really can hold it to maturity, that you don't need to mark to market. So it depends a little bit on how liquid the market is and what are you planning to do with that asset that you have in your book.
So a partial solution may be the way to go, basically.
And you also kind of touched upon it with the bank runs, but uninsured deposits played a critical role in the collapse of Silicon Valley Bank. Does that reflect a vulnerability that regulators should be more concerned about?
It reflects a vulnerability that we are aware of it. And I think that here's where, again, what sort of proper risk management from the point of view of the banks is important, because what was unique about Silicon Valley Bank is that the percentage of their deposits that were uninsured, because as you probably all know, us here in Europe, also the United States, we provide deposit insurance to all deposit holders. To everyone who has deposits up to a certain amount. In Europe, it's up to 100,000 euros per person and per institution. In the United States, it was up to $125,000. Then they increased as a result of Silicon Valley Bank. But what happened is that there were a lot of mainly companies that had millions of euros in deposits. Of dollars. Millions of dollars in deposits in that bank. So sure, they were covered for 125,000, but if you have millions, 125,000 is not so much. And then the second part is that those depositors, they were not so diversified because they all came from the same ecosystem.
Exactly.
They all came from the startups around California with private equity firms. So basically, they were if I might say, they were either the same people making the decision or they were very good friends. So the likelihood that you get, quote unquote, a herd behavior, is very high because they're all alike. And that's one important lesson learned. You need to diversify.
I mean, exactly. So despite the common notion that well-capitalized banks are safe, as you said, Silicon Valley Bank has shown that that's not necessarily the case. So do you think regulators are focusing a bit too much on counter-cyclical buffers, or as opposed to the other hand? So do you think they should be downplaying what we've just gone over, or is it just
No, I think we should be focusing on that part, but at the same time, you don't want this moral hazard. Right? I don't know if you guys know what moral hazard is. If you took an economic class, you probably know, right? So basically, what do I mean by moral hazard is like, if you insure, if the government, of the authorities insure all the deposits of the deposit holders, then the bank basically gets a free ride because it says, well, all my liabilities are insured. I don't have to worry about risk management because if I screwed up, the government will pay. And we don't want that, we don't want. So they'll take very big risks. The very big risks that will translate that into very big bets. If they pay out well, if they do well, they make the money, they keep it. But if they do poorly, the taxpayer pays. So you don't want that. You don't want that. You want them to have what we call a skin in the game, right? We want it to be a risk. So you don't want to insure everything.
Are bailouts not a bit of the same thing then, with this kind of like safety net for managers to,
But that's why we don't want to have bailouts, right?
Yeah.
That's why bailouts is one of the reasons that we want to try to avoid as much as possible, and we want to make sure that, at the European level and at the highest political level after the global financial crisis, there were two basic messages that were sent to us as regulators. The first one is we want to have an integrated banking sector, and we don't want to have taxpayer money involved anymore if there are problems. So no taxpayer money. So that's why, without getting too many technicalities, we increase capital requirements, we increase what's called MREL, which is contingent capital that's bail-inable.
And we'll get into that later, of course.
Good. And we have deposit guarantee schemes that are privately funded, resolution funds that are privately funded, all these schemes that are supposed to provide that the system, the banking sector, quote unquote, will pay for its own mistakes.
Yeah. Okay. Well, similarly to what we just did with Silicon Valley Bank, how would you conversely explain your perspective on what happened with Credit Suisse then?
Well, Credit Suisse is very interesting. It happened one after the other, right? Within like 1 or 2 weeks apart, but very different situations.
Completely, yeah.
Very different situations. Credit Suisse was to start with, was a very large bank. It was one of those banks that I mentioned before as a globally systemic institution, highly active across many, many markets in the world. And it was quote unquote a known problem. It was a bank that had strategic challenges over a number of years. They have changes in management. They have changes in the board. They have been involved in just about every scandal, financial scandal that had happened over the last 3 or 4 years. If there was ever a problem that had been discovered, something that was not properly managed, oops, Credit Suisse had an important position there. So there was this ongoing problem about it, And as a result of that's what happens, if I'll tell you one anecdote in a different way. You guys may know who Warren Buffett is. He's a very famous investor, right? And he used to say, he says, when the tide goes down is when you find out who's not wearing any bathing suits, right? So this the opposite is what happens also when the problems go up. When the problems go up, if you're weak, you're the first. The question is who's the next one to fall. And this is a little bit what happened with Credit Suisse. There was an increase in concern, and what we call like risk off, an increase in concern about the banking sector globally. They said, where is the weakest point? Where is the weakest point? Credit Suisse was a weak point, and it became vulnerable and had to be intervened. Fortunately, because I know you're going to ask me about this, I'm guessing. Fortunately, the way in which it was resolved, which resulted in financial stability. Because it was a global systemic institution, the concern will be that it will be contagion.
Exactly.
And then the tide will continue to rise, so the water level will continue to rise. And then who's the next one? Who's the next one? Who's the next bank to fail? That didn't happen. That generated the financial stability, and that was a good outcome.
Yeah, we touched upon it a little bit before, but as you mentioned, of course, managerial decisions were one of the main reasons, of course, why Credit Suisse failed. But in particular, the use of CoCos was a very, debated topic in the crisis. How do you think that their use reflected broader issues, basically in corporate governance, and in which ways have these products incentivized risky behavior, basically?
Yeah. Okay, so this was a very important issue in the case of Credit Suisse. As you know, so important that to provide financial stability, you probably know this, Credit Suisse was part of the name, it leaves you a little bit, it was a Swiss bank.
Yeah.
So it was under regulation in Switzerland. Switzerland is not the European Union. It has its own legal regime. So it was operating under a different legal regime. And here's where the interaction between law and economics is very important because, CoCos, which is basically bonds, contingent bonds, it's an economic instrument, but it's a legal instrument. It's a legal contract, and it has legal clauses. So you have to understand those clauses. And the way it was resolved, the way those instruments were basically written down under the Swiss regime is not something that is possible within the European regime. So, for instance, the first thing we did on Monday morning, when I say we, is me as the European Banking Authority, jointly with the European Central Bank, which does the supervision of the banks, and the Single Resolution Board, which is the entity that will have to resolve a bank in Europe if there's a problem, we came together with a statement in which we said first thing in the morning, Monday morning, before markets open, the way the Swiss authorities have implemented this resolution, it was not possible to do it in Europe. In Europe, will have to be done in a way that is different. What do I mean by that? Basically, is that there's equity This was called the ladder of liabilities, right? There's equity, regular equity. Then there's these contingent bonds, which are bonds that can become equity. Then there is bonds, then there's senior bonds, and then there's deposits. And that's a ranking, it's a ladder, that basically if you're bankrupt, the question is who pays, who loses their money? No? And the first ones that are to lose the money is the equity holders. And then once the equity holders, the next ones, which are the COCOs. And then the debt, and then the senior debt, and the insured deposits are insured. They would never lose their money at the very top end, okay? So what happened in the Credit Suisse, I'm sorry if I'm talking too long, is that the equity holders actually did not lose all of their money. They kept a little bit. And then the next one, the COCOs, they lost all of their money. That's okay under the Swiss regime, the Swiss bankruptcy regime. It's not okay under the European regime. And it's very important to provide a sense of how the rules work.
Yeah. I mean, on that topic, if we look at one of the institutions that was kind of blamed for what happened with Credit Suisse, it was FINMA, which is the Swiss Supervisory Authority.
Yep.
How would you say SSM, the European Supervisory Authority, does a better job, in your perspective at least?
Well, let me start by saying it's tough to be a supervisor. I'm not a supervisor. I hope not to be a supervisor. It's very tough to be because you get zero recognition when things goes well, and everybody blames you when things go bad. So, the first problem is the problem that was not FINMA. The key problem was the Credit Suisse executives. They screwed up the management of the bank. That's what the problem is first.
Yeah.
Okay. Then, sure, the supervisor had a problem. They had to intervene. As I said, they did it in a way that they preserved financial stability. So that's good. They did that okay.
Yeah.
They did okay. What would have been better? It would have been better, of course, if the bank was, quote unquote, orderly wind down, orderly restructure, orderly. What do I mean by that? If they did not go into this like crisis weekend, it would say, oh my God, I need to do something. Okay, but that happens,
Yeah.
I mean, life is full of surprises. You can never dismiss that. So, in the case of Europe so far, with the SSM, the SSM has had some banks that needed to be resolved. I come from Spain. There was a case of Banco Popular in Spain about 8 years ago that had to be resolved. They did it jointly with the SRB when, unfortunately, Russia invaded the Ukraine. Mm-hmm. There were a number of banks that went into stress that needed to be resolved within the European Union, and those were resolved as well. So this happens not all the time, but it does happen.
Exactly. So after we've discussed the crises that have happened, moving back towards the EBA, one of the EBA's most notable activities are the conduction of stress tests on European banks. In the past, you have said that stress tests are a core tool in ensuring the resilience of banks themselves. Could you briefly explain how the EBA conducts these tests and their objectives?
Yeah, very good. Thank you. So we do this. Actually, we do this stress test once every 2 years. We've been doing it since 2010, since the beginning of the crisis. And I think that the stress test helped in a number of directions. The first one is to help the banks themselves enhance their stress test capability. All that the stress test means is like, how will I perform if suddenly I'm confronted with a difficult situation? So you can think of what's that difficult situation, can be many things, right? Usually the stress test that we do is a situation in which the economic activity worsens. So basically we go into a recession or a situation of very, very low economic activity or very, very poor performance of financial markets, high increases in risk premium, things of that sort, and how would the bank perform in that situation? But there are other areas of stress. For instance, we are asking the banks to stress themselves what happens if they have a cyber problem. What happens now? We're very concerned about cyber. What happens if it's an operational resilience or a cyber attack? How will they react to that? As I mentioned before, we published early this week, how will the banks able to confront the climate challenge, the climate policy challenge? So we do different aspects. So hopefully our stress tests have helped banks do that assessment. What we do every 2 years, and we're starting the next one in January, and we'll publish the results in July of 2025, is basically we develop a macroeconomic scenario, which is, we develop two actually. The baseline, what the ECB tells us that the central projections for economic activity, financial markets is going to be over 3 years, and then we develop an adverse one. Basically say, well, this is going to go bad, and the narrative for next year is all about geopolitical. Geopolitical risks are going to increase. As a result of that, there's going to be fragmentation, decreased economic activity, unemployment, you build it. And then you think about what happens in different parts of the economy, in different sectors of the economy, and then you give that to the banks and tell me, well, now you tell me what's going to happen to you. You project. And they send us their results, and then the supervisors do what we call quality assurance, which is basically challenge those results. We go through 3 iterations of that. We put forward the scenario with the methodology, with the way to calculate. They send the results. Then the supervisors say, wait a minute. Isn't this a little bit too rosy here? Don't you think? How do you think that you're going to be able to do this when all the other banks tell me that X is going to happen? For you, it's only 50% of X or 20% of X, or this, or another direction. How can you still keep making profits when interest rates are going down, or things of that sort? That's what we call the quality assurance. And then, very important, we publish the results. We publish the results out there, and we publish the results with very detailed information, which the banks sometimes, often complain about it. But I think it's very good because transparency, is not only what they say, but can they also justify when people ask them questions.
Yeah, but you mentioned transparency, but sometimes details are limited to ensure the financial stability. So how do you balance the transparency and also risking not triggering any unintended consequences?
That's a very good question. But in my experience, the best way to address a problem is to show up. I like to say that showing up is 50% of the work. So if you really have a problem that people don't trust you, the best way is to show up, is to give information, to explain, to do what you have to say. So in that sense, I tend to think that when there is tensions about something, providing more information is always better. I'll give you one example, coming back to the Silicon Valley Bank of last year. A lot of that, as you said, had to do with the value of the held-to-maturity portfolios that banks had on bonds in their characteristics. Well, the first thing we did here in Europe, when there was the problem in Silicon Valley Bank, and we did at the EBA, we said, okay, well, look, last year we were in the middle of doing our stress test because we do it every 2 years. So 2023 was when we did the last one. Middle of it said, well, as part of the stress test, we're actually going to increase transparency. And we're forcing all the banks to tell us in every detail how big is their held-to-maturity portfolio. It was not in the initial methodology, but there was tensions on that part. So we just could publish the numbers.
And are banks always honest with you?
Well, I hope so. That's why the quality assurance is important. And when I used to work at the bank.
Yeah, exactly. You're in the perfect position.
I used to do a lot of internal presentations about the relationship with the authorities. I said, look, you have to think about this relationship. I hope this is not too long of an anecdote, but I used to tell them, look, this relationship is like a marriage. Okay, you're married to the regulator as a supervisor, but it's not just a regular marriage. It's prearranged. It's a prearranged marriage because you did not choose your partner; they did not choose you. It was the heads of state that said we're going to have supranational supervision. The ECB supervises these banks. Period. And it's a Catholic marriage because there's no possibility for divorce. There's no possibility. It's not to say, okay, I'm going to go get another supervisor. That's not possible. And it's also a medieval marriage because it's not an equal marriage.
It's the worst kind.
Yeah, one has always the upper hand. One has the upper hand. It tends to be the authority that has the upper hand. So that's sort of the relationship, How much they like us, I don't know.
Yeah. And were you a faithful husband then in this marriage? As you were for...
I've been happily married for over 30 years. So
there we go.
I think I have the credit to do that.
That's a good answer for that. Well, okay, shifting a bit more to theoretical marriage, more theoretical discussion and shifting away, unfortunately, from marriages. There are many schools of thought when it comes to how the banking sector should be structured in Europe in general. Do you personally believe it's feasible to have a homogeneous banking system made of pan-European firms across the continent?
I think it's work in progress.
Yes?
I think it's an aspiration. I think we need to be able to achieve that. I am, as I said, the European banking authority. We're responsible for writing a single rule book, for having common rules on a single market, right? So for us, it's clearly a goal. It's not a goal just for the sake of it. It's because we have clear evidence that is the best way in which we can be strong going forward.
Yeah.
When I think about the global financial crisis, what was the solution there? To build more Europe. When I think about what are the challenges going forward, and you probably have heard about the Draghi report and the Leto report, the challenges of the European Union going forward, all those tell us, well, as Europeans, we're, quote unquote, maybe lagging behind relative to other parts of the world, and the best way to come out of that is by rebuilding the single market, by building more Europe. So the banking union is fundamental for that.
Yeah.
So I think it's a work in progress.
One of the main arguments in favor of the banking union would be to increase the EU's competitiveness globally. And when you think about competitiveness, naturally the first place that comes to mind is the US. Do you think that European banks should strive to be more like American banks in that case then?
I think, well, more than European banks, more like American banks. I think that certainly there's one part in which most of us agree is that we should have a financial sector that gets more similar to the US, particularly developing capital markets. We should have more ability to have access to financial markets directly, both by investors, so that the citizens do not put all their money on deposits, but they do use other instruments, and also for firms to have more ability, particularly in like venture capital, startups, access by medium and large corporates to the market rather than just getting bank loans. All that part are really needs to be developed. The banks play a crucial role to do that because they're the intermediaries, they're the advisors in all those areas. So I think that's as I do think we need to get closer to that.
And is raising more capital compatible with higher levels of regulation here in Europe, since we do have that?
Why not? Absolutely. Absolutely, it is compatible. Because at the end, the key component for markets is that you think that the rules work.
Yeah.
I'll give you an example. It's like there's so many financial contracts in the European Union that are written under the rule of law of the UK. It's a bit paradoxical, right? So many other ones. Talk about the COCOs. So many of the COCOs, the bonds that are being issued by European banks are issued under UK law. Because there's the perception that it's a legal regime that is, quote unquote, I don't know if predictable, but at least understood in the context of financial and economic activity. Well, that's helpful. Having good rules, having a good rule book, having predictability, it's important. One of the big challenges, for instance, in the European financial sector that we talk a lot about is like the differences in insolvency procedures across the 27 member countries, our bankruptcy laws, our national, they're like big differences. How long does it take to take a firm that goes into bankruptcy to the courts, and how much do you recover in that process if you have financial obligations with them?
Absolutely. And other than, of course, the competitive concerns, critics of a banking union argue basically that homogeneous standards applied to like a very heterogeneous set of economies like the EU is might end up negatively impacting peripheral countries more than central countries. Do you believe this is fair criticism?
I think it's fair criticism, but I think it's exactly the same thing you could talk about in the United States. If you think about what does Alaska have in common with Texas? Oil. Apart from that, not many more things actually they have quite in common. But what does Texas has in common with New Jersey? Not that much. Not that much. Or Boston, where I spend a lot of time, has in common with Iowa or with Idaho. I think that Cyprus has much more in common. First of all, we're certainly much closer. We're geographically smaller. And I think Cyprus has many more things in common with Portugal or with Spain or with Northern Europe that probably the United States does. So I don't think that argument goes that far.
Yeah. Okay, well, fair enough. So I think it's time to look at our audience now and see if there's any questions stemming from them right now. Yes,
here.
just right in front.
At the camera.
Thank you so much. That was super interesting. A different question about banking regulation. In 2012, I saw that there was this banking regulation implemented on short selling as a response to 2008 and the euro crisis. And market makers and primary dealers are exempt from that regulation because of their essential role and the function. But I was wondering to what degree you figure they also might increase the risk that are attached to short selling, in the sense that particularly maybe primary dealers have an incentive to engage in short selling in their hedging when from the auctions. Particularly when they're big, they obviously can have an impact and make markets move and profit from short selling. So I was wondering what your take is on that.
Yeah. I think that, as you very well pointed, there was this ban on short selling, and as an economist, first of all, as a regulator, I find it a little bit asymmetric. People are happy when things go when things go well, and they're not so happy when things go bad. So people are happy when prices go up, because usually people are long, they're invested in that, and they're not so happy when prices go down. But there's nothing moral when prices going up or down. Prices should reflect the value, right? So short sellers are actually helping what we call price discovery, because they're betting if prices go down that they think that's the way it should go. So they're helping us in that process of price discovery. So that's good. What's not so good is when they have market power. So when they by them moving in one direction, they help move the market and they make money. But that can happen in both directions. That can happen when you buy. Sometimes that we call that squeezing a market. Also when you sell. So what's important is that you have those two things in mind. It's not whether you're buying or selling. It's not short selling versus not short selling. It's the market power in there because there's not enough liquidity. So as a result that you taking an action, you're actually entering into a self-fulfilling prophecy because you're moving the market with you. And that's the part that we need to be worried about. Now, since most people buy rather than short sell, it's more likely that the market power materializes when there's short selling because there's less people on that side of the market. But that's the part. So that's why we usually, when we think about bans on short selling, we look at how much liquid the market is. When you think about a particular stock, for instance, how much liquid that stock is, and that gives you an idea of how much short selling could be allowed.
Any other questions? We
Yes.
have one question right over here.
Thank you very much for these wonderful elaborations on the markets. I would like to ask, how much do you think that banking regulation considers the role of the everyday man, so to say, or the clients of the banks rather than the banks themselves? For example, regulating the profits of the banks or ensuring that banks work out for everyone, not just that banks operate and work well.
Thank you for the question. Because first of all, we are concerned for a big chunk on what we call the prudential regulation, which is really what we've been talking about, which is making sure that the banks are robust, are sound, that the depositors are saved, which is one part of the market, and as a result of that, there are no banking crisis or financial crisis. But there's a part of that, it's another part that you're mentioning too, which is also that they're offering good, proper services to customers. And then there are two aspects. One is competition, that they are competitive and they need to compete. And for that, we don't have, that's not my responsibility. We have, in Europe, we have competition authorities, and they're the ones that are responsible for that. National competition authorities, or at the European level, the competition, the DG of competition in the Commission, and they should be looking at that. And then we have also a consumer protection. So there's no market abuse, there's no mis-selling of products, and that partially we are responsible for that, and we pay a lot of attention to that there's no crime, anti-money laundering, terrorist financing, there's no financial exclusion, which is another issue that we've been confronted, and that we do look at that relatively carefully, particularly the area of financial exclusion. And it's interesting because, for instance, financial exclusion is coming in ways that we're not used to it, expected. We used to think that financial exclusion, particularly access to banking services, was a problem that was primarily first on emerging markets rather than on developed markets like the European Union. And second, a problem that's very much linked to income. So lower income people have more difficulty accessing banking and credit markets. Well, now it turns out that it has a lot to do with technology. So you have a lot of older populations, maybe less digital populations that feel that they're getting excluded. As they have to access, like bank branches disappear, things of that sort. So you have to see how that evolves. 2 years ago, we paid a lot of attention to immigrants, refugees coming from the Ukraine into the European Union to make sure that they had access to financial services, that they kept the ability to also pull out of their banking services and their banking assets that some of them had back in the Ukraine to support their families. So that's areas in which we do pay attention.
On that note, I think it's time to move back into our discussion here. Moving beyond just traditional regulation in the banking sector in the past few years, we've seen the rise of shadow banking and non-banking entities. How would you say the rise of these institutions affects the state of systemic risk within the financial sector?
That's a very good question. That is a question searching for an answer.
Yeah.
We don't know. I mean, the reason we don't know, first of all, as you said, now we're talking about non-banks I'm responsible for the European banking authorities. It's a big so like awkward for me to talk
Gray
about.
area.
Yeah, to talk about them back. But then you also mentioned shadow banking, which I think is important, which gives you the sense, shadow. We do not have a lot of information about the activities that are being done in the financial sector outside of the regulatory area of banking. And that's an area of concern. It's an area of concern, first of all, because we don't have the information. Second, also because it's grown a lot over the last 10, 15 years. So when you see something that's grown a lot and that you don't know a lot about it, then to worry about it. Exactly. So the first step that we need to do is to make sure that we get good information, that we increase the reporting that comes out of there, that we understand what the different linkages are. And that's where we're now. We're now in that process. And I think it's important that we develop that more to ensure that there's no systemic risk, as you said.
Of course.
And while the EU recently introduced MiCAR as a framework basically for governing crypto products across the continent, where did the challenges lie when implementing regulation that kind of encompasses such rapid technological developments?
Yeah, I mean, when you are thinking about new technologies, it's one of the comments that we always hear is, well, the regulators, the authorities always go behind. It's absolutely true. It's absolutely true because it's very hard to regulate what you don't know. It's very hard to regulate what doesn't exist. So the way that normally things go is like technologies are invented. Those technologies give results to products or services that are getting provided to customers by specific firms. And then we go in and we look, wait a minute, is that product that's being provided to the customer okay? Is it good or bad for them in a very simplistic way? And second, is the firm that's providing the product reliable? And then we regulate that. But you need to have those two things.
Yeah.
In the crypto world, it's very, 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 for me, telling, because we as regulators, we felt for a long time that we went from the technology to a big, big bubble in asset prices without thinking about what the hell, what the product is.
Yeah.
And who is providing this product? Who is the firm that's providing the product that's able to generate these assets? And we're not happy about that.
Yeah.
So we're discouraging, citizens, firms, banks, in my case, to engage in that process. MiCA, the regulation is the Market in Crypto Asset Regulation, which came into effect in June of this year, in Europe is the first attempt to try to say, okay, there are certain products would use this technology, use crypto technology that are okay for financial markets. And as a result of that, I think we should be regulating them and operate them in a reasonable way. Particularly, those are the ones we call stable currencies. Those are cryptos that are fully backed up by reserves that can be substitutes for money, for credit cards, for electronic money, essentially as payment devices. And that's what we're regulating now in Europe. That's good.
Yeah, absolutely. And are you sort of satisfied so far with how markets are responding to it and how it's going, basically?
I'll tell you, so far, we'll start overseeing this technically in January. We're now in the process of pre-authorization, authorization by competent authorities. They start being supervised in January of this year.
Okay.
But of next year, sorry, 2025. But one thing that I can tell you, this is just from my direct experience, when you started to see the minute the regulation came into it came into place, that there were two types of firms. There were those that were very eager to engage with us, to try to understand how the regulation was going to work, because they wanted to be legal, and the other ones that are very happy to stay in the shadow. That I never hear from them, that I never see them, that they are sort of like in the coming back to the shadow banking, maybe in the dark matters of the crypto world.
Yeah.
So that helps. That's help because obviously you can distinguish. I'll give you an analog that I say all the time. It's like the English language is wonderful for this. It's like drug. It's like a drug. What's a drug? A drug can be two things, right? It can be a pharmaceutical. Right. It can be a drug that's perceived to be negative. The chemical compound is the same. The question is, how do you use it and how do you distribute it? Who is the firm that distributes it? What are the uses that you get out of that? It can be good or bad. Crypto technology is the same thing. Well? Most technologies are the same things.
What is the regulation as well between?
Yeah, well, the regulation helps you distinguish between those two uses, right? I think that's the same thing with the crypto technology. The regulation will help you what are good uses and what are sort of like no-safe uses.
But you kind of touched upon it earlier when you said that people think that regulation is behind. How, as a regulator, do you balance the need for regulation itself and not trying to stifle technology and innovation?
Right. So there are two parts. The first one, we'd like to say that we want to be technologically neutral. What that means is that basically that by picking that by writing the regulation, we are not implicitly or explicitly favoring one technology over another, unless there's a case for favoring that technology. Neither we're favoring one firm over another. That should be sort of the market that drives those dynamics. What we should put is guardrails. So like within this range of usage, we think it's okay. But if you go beyond here, we think that it becomes either too risky or it's not desirable at all. Yeah. And so you need to manage those guardrails.
Yeah, absolutely. And so as we unfortunately come to the conclusion of this interview, there's one last topic which we haven't really talked about, but I think is quite important to mention. We always assume that regulating is easy, but I think in reality things are a bit more difficult. How much does politics influence your work?
How much? Well, politics is everything in life. Politics is the way we decide how we manage ourselves. Yeah. Unfortunately, fortunately that we do that, because the alternative is much worse. Which is somebody decides for us, and that's much worse. So of course it influences us. We get mandates, as I said before, coming from level 1 regulation, which is decided by the European Parliament and the governments. So those mandates are shaped by those bodies, which are essential political bodies. It's the governments on one side and the members of the European Parliament on the other. And that's good, because they are the ones that represent us. So that shapes us. Our job is to provide them. We do a lot of work of what we call for advice. Yeah. We provide them information saying, if you want to regulate this, we think that these are good things, we think that these are bad things. Coming back to the crypto world, for instance, for 4 years, we've been issuing opinions and warnings. Yeah. And this is a sector that we worry about. This is a sector that we think that should be regulated in particular ways. And now MiCA came about, and they took on board many of our comments. And now the co-legislators are revising what's called the Payment Service Directive that regulates how we do payments, how we pay with our credit cards and things like that. We also wrote them before, a year and a half ago, we wrote 130 recommendations of how the regulations should change, given our experience, because we've been responding for the last 4 years to the industry, asking us questions about how the regulations should be applied. So we sent them 130 recommendations. And if that was not enough, then in April, we run them back and wait a minute, because we have also discovered there's a new fraud. The new ways that fraud is taking place in payments that the fraudsters have discovered. So maybe you want to put these things also into the regulation to try to counter that. So we provided that feedback. Mm-hmm.
But is EBA then fundamentally kind of limited in its scope based on the political winds that are going about in Parliament?
Well, I would say based on the political, we're certainly limited in scope by the regulation and the mandates that we're given, and that's absolutely right. We're also accountable. We need to be accountable for what we do. So I go to the European Parliament once a year and testify. I go to the Council also regularly, at least twice a year, and provide input. And that's good. We need to be accountable. But at the same time, as I said before, we're sort of like, quote unquote, independent. We have our own board. We manage our own dimensions. So that gives us a little bit of independence. But being independent doesn't mean that you're not accountable and that you're removed from reality.
So do you then think that independent institutions like the SSM, for example, are similar to you in terms of the waters they can navigate, or like are they?
I think we're similar with all of us have our peculiarities, but we're similar in that process. I think that level of distance allows you to implement sometimes difficult decisions based on a technical level, but you are subject to the overall legal framework that we have chosen for ourselves as democratic societies.
But do you ever wish you had that sort of independence as well?
Everybody wishes they didn't have a boss, right? Everybody wishes they didn't have boundaries, that they could do whatever they want. So in that sense, yes, I wish that, but I'm very happy with the structure that we have.
And given the distance that you mentioned between the SSM and, say, the EBA, and their inability to cooperate as a result, do you see the overall stability of the financial market as the real loser in that situation?
No, I hope not. I think that it's true that as we build the European Union, complexity is increasing. It's certainly true that when we went from national to supranational, we implicitly add a layer. There's more coordination. It's also true that technology is making things in some ways harder. I'm the European Banking Authority, but technology is merging sectors. And that makes it harder, to just regulate one sector because there's more interlinkages. Technology also makes it much more easier to move cross-border. I'm European banking, I'm not global banking, so I have to build on that cross-border collaboration with other jurisdictions around the world, because technology, in that sense, is pushing us and very, very challenging to make sure that there's coordination there. So I think that adds the complexity. But I hope that the complexity itself does not lead us to more instability. On the contrary, it helps us to foster stability.
There's different ways of seeing this. I think we have time to squeeze one more audience question in, if somebody is very adamant. Yes, we can go for it.
Over here.
Is it okay? So I was wondering where we're now switching, specifically in Europe, but trying to switch to more technology-based industries when it comes to assets and collateralizing assets. Intellectual property rights are still rather falling behind when it comes to traditional assets such as immovables, real estate, etc. How do you see how we could make that switch? Like, do you think it is realistic that something like intellectual property rights could be collateralized and have lower risk weights, or are there like clear disadvantages which are just too big?
Yeah, that's a very good question. You know, it is true that many of the assets that we invest in now are not as natural collateral for debt. But that has two implications. One is you can think, okay, well, I need to make them more, quote unquote, eligible for debt. If their nature is like that, yes. If it's not, not. And the second aspect, well, if they don't have that nature, then I need to provide a different kind of financing, which is mainly equity. And that's where I think the big lagging part of Europe is. We don't have enough equity markets. We don't have enough startups, venture capital firms that are financed through quote unquote venture capital funds, startup funds, things of that sort for those type of firms. And I think that's at the core of the problem. That doesn't mean that you cannot do anything on the other side. I'll give you an example, for instance. It used to be the case that the regulation of banks, you know, those intangible assets were sort of like considered not valuable for the case of resolution. So basically, were written down from the equity of the bank. So that led to the paradox in which, you know, we were telling banks, you need to invest in technology, you need to invest in the future. And they say, well, every time I close a branch, which is a physical asset, I sell that physical asset, and I invested in software. It turns out you say I should be doing that to invest for the future, but my capital drops because the physical asset was eligible for, as you say, for collateral. The other one is not. So we actually changed the rules. And we say, okay, we'll give you for that software, you know, we'll put, basically, to make it very simple, but we just assume that the expected life expectancy of that software is 3 years. So for the first 3 years that you invest, that's recognized as an asset. After that, we think that's depreciated. So that's a way to make the rules so like go in the direction that you think is proper.
Well, we would like to end this interview basically on a positive note, and we were talking before a bit about the complications that arise in Europe. Why should young students who are passionate about the safety of our financial system still believe in EBA's mission and possibility to be successful in it?
Not only they should believe in it, they should apply for a job at the EBA.
There we go.
We need you. So I think you should think about this. I'll tell you, you know, I'm not young, you know, but you asked me why did I go to the EBA. When I thought about, you know, what, at my age, you think about this. You know, I have kids and they've gone to college already at that point. I said, like, you know, what is it that I can dedicate my final years or whatever I have left of my professional career that has meaning? That has meaning, that's something that helps for the future. And I said, well, building on the European project. Yeah. Now, if I can build on the European project, there are many parts of the European project that you can build upon, but a person like me that's always worked on international banking and finance, where should I go? To the EBA. So if you think on those two components, you know, you think of the European project as a European project that's worth sort of getting involved with, and you like banking and finance, we are the place. As simple as that.
Well,
it's as simple as that. And actually, to be honest, when we do our staff engagement surveys, which is surveys within our organization of our employees, you know, one of the things that comes higher, but if not the highest, is the sense of mission. Yeah. The sense of mission that we have as an institution. So I think that's actually quite exciting.
That's a lovely way to end up this interview then. I would like to thank you so much, Chairman Campa, for coming here today and sharing your insights with us. And I would like to thank the audience who took the time to come and listen to us today.
Thank
Those of you who couldn't get enough of Room for Discussion, we have good news. On the 26th of November at 6 o'clock, we will be having Edith Hoge, the chair of the SVB, for an interview at De Brugge. But to finish off, let's have a lovely round of applause for José Manuel Campa.
Thank you.